What is ahead for stocks as we kick off the first day of February, which is sometimes treacherous for stocks? Joining us here at Post 9, RBC Capital Markets head of U.S. equity strategy, Lori Calvasina, target of 5150. It's good to have you back, Lori.
Thank you.
What'd you make of the reaction yesterday?
So, to be honest, I feel like there was just so much on this market that it felt like Powell was the last straw. I mean, we've had a deteriorating geopolitical backdrop. Hard landing discussions have been back in the conversation this week. That seems to have been a little bit of a sudden shift in my meetings. A lot of people have been kind of parsing over the employment data, temp workers, that sort of thing, looking for signals there. We had the banking blow up yesterday, and, the market was pretty resilient through all of it. I will tell you, though, I've been telling people we should be looking for a pullback based on what we're seeing on the CFTC data, AAII. They both have been signaling that we need a bit of a pause in this market. So I'm frankly surprised it hasn't happened yet.
February, I think, the second worst month of the year. Does that mean you are cautious for the next few weeks at least?
I mean, I was cautious in early January, and that didn't panned out for like 2 days. But you do tend, if you go back and look at the seasonality over the last 10 years, and you kind of look at January, February, March as a whole, we often do have some pretty nasty months. At some point within the first quarter, the timing just does vary a little bit.
That said, how would you argue earnings are holding up within Mag 7, 6, and the rest?
So I would say, kind of getting these disappointing big tech earnings was not on my January bingo card, but I think in retrospect it probably should have, because this was the one sector where earnings revisions were going up coming into this reporting season. So I think expectations had just gotten too high. Valuations are at peak. Crowding, positioning is at peak if you look at the futures market data on NASDAQ. So I think, the bar was just set too high here. And I think the rest of the market, I do think that as cyclical expectations improve, that should give a lift to the earnings expectations of the rest of the market. But it's just going to take some time for that to play out.
I think we should talk about the regional banks for a second, which is somewhat ironic because in the Fed statement yesterday, they took out the paragraph that they had been including for several months about how strong the banking system actually was. And then we got this huge slump in shares that's continuing today. Is it idiosyncratic, or do we have to worry about the health of regional banks again?
So I think, again, given where sentiment is, we always have to be vigilant. And given what we went through last year, we have to be vigilant. That being said, our team, our banks team, our rate strategy team, they are in the idiosyncratic camp right now. So, what I was noticing, I was out on the road yesterday talking to investors. I didn't really sense any kind of big panic. I think people were watching. So I think, I'm in the idiosyncratic camp for now, but we'll keep an eye on it.
Yeah, I mean, clearly affecting sentiment, and we still are in a place where we have, credit normalization, higher interest rates, potential commercial real estate losses, regulatory squeeze. I mean, these are broader issues facing the sector.
What I thought of yesterday, and I was getting on the plane, just as Powell was starting to talk, so I wasn't sitting in front of my monitor, but I did notice, at that point in time, the small caps were holding up very well, value was holding up very well, and really most of the damage that was done on my screen through early afternoon was really just this broad-based weakness in technology, and not even just the names had reported. To me, what this kind of new question about the regional banks does is throw kind of a wrench into the rotation argument. I think this market is ready to rotate into other things besides big tech. But for that,
why do you think that?
I've just been sensing it in conversations. If you go back to August through October when yields were rising and the big cap tech trade was really roaring, I felt like a lot of investors were paralyzed. Either you owned them and you couldn't own anymore, or you weren't going to chase it at this point in time. And it was almost like a big celebration when yields peaked and people were able to rotate late in the year. And now, I think people are kind of setting back. They've kind of made a lot of their moves. But I don't think that people who were in that camp of the AI-related stocks, these big mega-cap names, they're too expensive to own, they're not changing what they're saying. I mean, the number of questions I continue to get on a daily basis on concentration on the market and just random data points people want, that hasn't died down. That's still here.